welcome to the three of you. I'll do very brief introductions beyond the names that Nina just read. Afsana Beschloss is the founder and CEO of the investment firm Rock Creek. Wei Sun Christensen is CEO of China and co-CEO for Asia Pacific of Morgan Stanley. And Mark Machin is president and CEO of the Canada Pension Plan Investment Board. A warning to all of you, this may feel like a China investment panel because it's very important to everybody on stage and of great interest to me. I'll do my best to make sure we talk about other things because China isn't the only important investment opportunity in the world. But Wei, I would like to start with you if I could. And I'd like you to start by sharing with the room your overall investment thesis and the, let's say, the challenges and the opportunities that you see in the world today.
Yes, very interesting, and I'll help you to make this not so only China focused.
Thank you.
Because I'm going to talk about the global growth first. The sustained global growth for the past 2 quarters actually is very much driven by the increase in capex as well as in the productivity gains in the US. And I think this, I want to mention 3 things that might derail this growth trend. And one is the strengthening and potential continued strengthening of the dollar. And the second is actually the non-financial corporate debt, the credit actually has reached a quite high level, actually exceeded the pre-financial crisis level. And thirdly, I'm going to talk about the trade tension between China and the United States. And so on the trade front, that people have seen this protracted trade tension that actually has been potentially, escalate for a few quarters going forward. Although we think that it is still going to have a kind of a contract negotiated outcome in the end. But I think it's important to point out one thing. It's no longer about China and the United States, because we are in this global supply chain nowadays that actually trade issues absolutely involves the rest of the world. Give you a very simple example. iPhone 10, the components cost about $370. 110 actually goes to Korea, goes to Samsung. Right. And 44 goes to Toshiba and SK Hynix. And some more dollars actually goes to Taiwan, US, and Europe before China assemble. So when we talk about trade, the second point, when we talk about trade deficit, 370 billion, large amount. And people think that this is all made in China goods, but yes, they are made in China, but the reality is, out of the total export China has to the United States, 506 billion, 60% are made by multinational companies in China. Either they are wholly owned entities or joint ventures in China.
So let me get you to react to something that Jonathan Wetzel of McKinsey said this morning at a breakfast panel that we did, which was that the slowing Chinese economy and the issues that the Chinese economy are having and the US-China trade tensions are literally a coincidence. That yes, they are both happening, but they aren't necessarily happening because of each other. Do you agree?
I think the Chinese government has plenty of tools to really stimulate the economy. First of all, monetarily, the easing policies, right? We saw RRR rate already being cut, and also, the infrastructure investment can be increased. And also, I'm going to talk about later about consumer. Yes. Consumer is already huge percentage of, 57% of GDP already. And the Chinese official, let me quote Fang Xinhai, who spoke at Davos, Tianjin. He said, if
And I'm sorry, he is the?
He is the vice chairman of the CSRC, and he spoke on the trade issue quite openly at the Davos in Tianjin recently. And he said that if the full imposition of the tariff, let's say 25% on China, on that entire 250 billion, the impact of the Chinese economy actually is 0.7%. Yeah. Our research is 0.6%, but China is growing at 6.6% this year. So if it slows down to 6%, I think they can stomach.
And so I want to remind you, if we have time, and I hope we will, that we want to come back to this issue of corporate debt and the US dollar. But first, Mark, I want to turn to you. First of all, remind me how much money your fund is managing?
366 billion as of the last quarter.
Okay, good. So we care what you have to say in particular about your macro investment thesis.
Yeah. So I'm going to take. I mean, I agree with a lot of what Wei said, but I'm going to maybe pick 4 other things. So I'm going to take a long lens, rather than what's going on in the next 6 months or a year or whatever. Because we're investing for the retirement security for 20 million people in this country. So it's the really long-term lens that matters to us. What happens over decades, frankly. So I mentioned 4 themes that we worry about in the long term. One is disruptive technology, and on a day when you look at Sears this morning declaring bankruptcy and possible liquidation, that's case in point. So many companies getting disrupted, and so we worry about that across our entire portfolio, and we look and study that and follow that. Second is demographics and the demographic shifts that are happening in the world, whether it's the aging baby boomers in the US, whether it's profound aging in China, or it's the other demographic shifts that are happening around the world, China, Japan, et cetera. Third thing is the shift of the economy towards emerging markets. So by 2025, on current projections, 47% of global GDP will be in emerging markets, and goes over 50% sometime between 2025 and 2030. But that shift is underway. And already, 40% of global GDP is already in Asia. 50% of the population is in Asia, 50% of fixed investments in Asia. So all that shift is well underway, and the economic center of gravity is moving. And final one, I'll shout out to climate. We just published our sustainable investing report this morning. We are believers that climate change is happening. And so we are doing all sorts of modeling and analysis about how that is going to impact everything that we do, first order, second order shifts and impacts.
So give us one example then of how you invest now on these things. I mean, one I would assume is that you have to make a determination, are we going to be market weight, underweight, overweight on emerging markets? But another question would be, do you invest now on this climate thesis, or is it something you study?
Yeah, so there were a few things. A quick answer.
Sure.
One is, so we've set up a group internally called thematic investing, and that group is explicitly looking at these types of themes and trying to find the best way to extract value from them. And for example, and it may not be obvious. It may be something that's sort of second order. I'll give an example where we made a substantial investment in a company called Viking Cruises about 2 years ago, which does river cruises in Europe. And the reason for that was the fact that you get this aging baby boomer population in the US. They all now want to travel to Europe to go and do sightseeing in Europe. And one of the best ways to go sightseeing in Europe is go and take a river cruise. So almost all of the people on these boats are aging baby boomers from the US.
I'm laughing because I think my father is on one of those cruises this very minute.
Yeah.
True story. Yeah, he's not an aging baby boomer.
Please, everybody should go. We're a big investor.
Yeah.
So it may not be intuitive, immediately intuitive. You need to find exactly where. I think the big themes are understood, but exactly where to extract value and how to extract value may not be obvious, and that's what this team does. In terms of emerging markets, we have made a statement that in our strategy, which rolls out to 2025, we said up to a third of our portfolio will be invested in emerging markets by 2025. So 47% of global GDP. We're not invested in every emerging market. We don't invest in Africa or in frontier markets, but so we have a major focus on China, on India, on Brazil. They're the sort of 3 big markets that we're focused on. But we're going to move the portfolio and our expertise to be able to invest in those markets and scale. On climate, climate affects almost everything in our portfolio in some way or other. So it's really understanding the risks and whether we're being compensated for those risks over time. So it could be regulatory risk, it could be stranded asset risk if you're invested in something in the resources, it could be changing consumer behavior. It may be shifting supply chains just because where things are going to have to move because water's not going to be available in certain areas. You're going to have shifts of population. So those things are important for us to understand when we're investing money with a long-term horizon.
Good. Afsana, to start by just telling everybody a little bit about what your firm focuses on and then your view of the world, if you will.
Thank you. We invest globally across a number of markets. On behalf of sovereign funds, pension funds, endowments, and foundations. Basically, what we're seeing in the marketplace is that in the US, interest rates will continue to go up despite the president questioning the Fed's plans and trying to affect it, which was sort of an interesting historical event last week.
We're full of interesting historical events these days.
Every day.
Yeah.
So we think that there could even be an extra number of rate increase on top of what the market expects. That could go either way. I mean, traditionally you think that affects the markets, the equity markets, but of course there's so many other things happening geopolitically that could have much bigger impact than interest rates in the short run.
Can you, excuse me, when you say you think there will be more interest rate increases than other people are predicting, you're both, I assume you're both making a forecast and saying you think that's an appropriate policy move?
Our belief is that wages will go up, inflation will go up, and it will be an appropriate policy move.
Okay, very good.
So, in terms of Europe, on the other hand, we think that the pressures will be the other way around. All the other problems that are going on with Europe, we think interest rate increases will probably be on a slow path. Emerging markets, very much like both of my fellow panelists, we are extremely excited, very bullish. Emerging markets, though, can be your worst investment in a given year or your best. And I think what they're showing themselves to be, and I spent 20 years at the World Bank, so we've seen sort of those markets up and down a lot. You really have to look at emerging markets over the long term, as you were saying. You have to have a 10-year perspective, 5, 10, 15-year. And we think that, across Asia, obviously, there's a lot of interest, but even outside Asia, whether you're looking at Eastern Europe, Latin America, there are pockets of interest. The thing I think that is most interesting in these countries, though, is the intersection of what we all broadly call ESG impact and sustainability. I think those have all been sort of put in a box, and most people, when they hear those words, their eyes glaze over. They assume that those are non-returning kind of ideas that are being put forth by PRI or other kinds of mission-oriented groups. Having worked on sort of those kinds of things over a very long period, I think we are at a very interesting time where you actually will make money investing in these. If you had invested just in MSCI emerging markets the last 10 years, or if you had invested in emerging markets, just the index, health sector, you would have done much better with the health sector. I'm not saying all the health sectors impact, but a lot of it is. So if you're looking at investing in things that do have a social impact, but actually do have returns, I think we will be seeing a lot more of those.
And Mark, if I would interpret what your earlier comments that you would agree, and with this, your focus on climate as an example?
So I think the way we look at everything is through a risk and return lens. So that's basically, that's our mandate. That's what we're asked to do when we were set up 20 years ago, which is maximize returns without undue risk. So so we need to understand what's the potential return behind this investment and what are the risks behind the investment. And one of those risks, it will be climate. And so that's what we're trying to understand and price, and trying to figure out how to price that risk. And one of the things that has been an important initiative in the last few years has been better disclosure and standard disclosure. And so under Mark Carney's leadership, the Financial Stability Board had a group that got together to try and create financial disclosure standards for companies so that when we look at the thousands of companies in our portfolio, we can get numbers that we can then consolidate up to understand the risk we have in a portfolio. Without that, it's very difficult to understand what you've got. So there's about somewhere between 400, 500 companies that have signed up to these new disclosure standards now. We hope there'll be a lot more that will sign up, and then it's much easier to understand. But in answer to the question, as long as we're trying to understand the risk and make sure we're being compensated for it.
Although I thought it was interesting, you said earlier quite clearly and transparently, the fund doesn't invest in Africa. Presumably, the risk is too high for what you're trying to accomplish.
Well, I think it's more, we don't have unlimited resources. We need to keep our cost base sensible, and therefore, in my view, and I spent a lot of my adult life in emerging markets, they are tremendously fun and interesting.
Yep.
But you need to be deep in markets. You need to understand, what's really happening.
Yep.
And for us, I want to make sure that we don't just have one investment in one country, but we have a bunch of real estate experts, a bunch of infrastructure investors, a bunch of fund investors, direct, public markets, private credit, fixed income. And then when you have all those people investing in markets in different ways, then you get a better understanding of what's going on. If you're just going into one country and making one investment, you're going to get picked off anywhere in the world.
Fair enough. Wei, would you please react to Afsane's comment about interest rates? And I think that plays into your observation about the risk of corporate debt in the United States.
Yes, I think the interest rates actually is going to put pressure on the emerging market. That's for sure. And together with the US dollars getting stronger, and that is no doubt going to attract a lot of investors back to US. And also will put the pressure on the central banks in the emerging market in terms to exercise some tightening policies. I think that is no doubt the situation. And also if you look at China, there are a couple of things that seemingly also create challenges, right? First of all, you have a weak capital market, and the government, since for the past 1.5 years, have been very focused on deleveraging. And because China has a big debt liability, 283% of the GDP, so the government is very focused on that. And the renminbi is depreciating. The renminbi's depreciation has a lot to do with the hike, and the dollar's strengthening because of the divergences on policies of the two central banks. And but come back to the topic of investment, I think I totally agree the investment in emerging market has to be long-term, but at the same time, at any given time, you have to be nimble, then you have to constantly adjust your strategy. Because in bull market and down market, there are always good opportunities, right? So for instance, right now, with the current pressure, in fact, capital raising in terms of availability of funding has dropped to 50 to 70%. So this means the overheated valuation of the domestic market now is going down.
I'm sorry, you're speaking about China specifically.
I'm talking about China specifically, because of all the three factors that I talked about. So hence, as a result, a lot of investors start to sell their assets. And when the supply exceeds demand, the valuation of these assets goes down, creates great opportunities for newcomers to come in to buy. In addition, this deleveraging efforts is creating more corporate defaults, which is not necessarily unhealthy. The government start to allow that to happen. And that is great opportunities for distressed asset situation investors, and also debt refinancing opportunities, and also buyout opportunities. Rarely China has buyout opportunities.
Well, right, so that's exactly what I was going to ask you. To an outsider's ear, the notion of distressed assets or buyout opportunities in China sounds unusual. But you're saying this is, Mark's making a face. First way, you're saying this is a reality, and then I want to...
Depends on your lens. I mean, it depends how far back you go. I mean,
the buyout actually is not solely driven by the distressed situation. It's actually the timing of the reform, the 40 years of reform. You have these private entrepreneurs, and now at the age of 60, this is generational succession situation. The parents will no longer be able to pass the business to their younger generation, their children, because they may not have the aspiration to run the companies, or hand situations appear. And another situation is take private. Because of the weak capital market, obviously, that has happened. We, for instance, have done 3 or 4 take private, and then the market actually is quite active in that. Those are all very good opportunities. And let alone the other aspects. You stop me if you think I have talked too much. I think this,
I will.
China, we are very bullish on certain sectors, in particular technology, fintech, for instance. This is where you really have, China has created a very unique ecosystem under fintech. First of all, you have this 800 million of internet users, and then you have an underdeveloped banking system. Who have imagined the Chinese banking system after all these years that is not catching up with the speed of the economy? 1 out of 5 individuals in China actually are now banked.
Before we move on, let's cut to the heart of this matter, which is the mega cap Chinese companies have all experienced dramatic declines in their share prices in the last few months, and there are many reasons for that, including this uncertainty about what the government will or will not allow them to do in the future. What is your view on that? Is that strictly short-term thinking, and the longer-term picture is clear?
You're right. I think there will be downward trend for the corporate earnings coming. And I think it's largely driven by the deleveraging effort, the tightening, and the government, although started to exercise some kind of easing, but that has not been felt yet. And also, retail sales have slowed down, right? And the tension of the trade is hanging there. And so those are the factors, but they are sector specific, but even for consumer sectors, you've seen the slowdown. Consumer is 59% of the GDP and will reach 71% of the GDP in terms of contribution. So all in all, you can say it is actually the slowdown of too fast, but not bad, but very, very unusually fast the speed of development. Maybe this kind of speed right now is normalized. It is not bad news.
It feels like something of a replay of the great U.S. consumer internet companies in the last downturn, that they had huge business opportunities in front of them, and that's exactly what happened. You both wanted in on this. You first, Mark, and then you have Sana.
Well, I was making a slightly different point. It was unusual to see this. I mean, you know, with a longer lens, I mean, there's been times when nobody's wanted to buy China at all. And before, you know, China got so big, you know, literally virtually nobody internationally. So we look at 1994, 95, 98, 99, 2003, 2004. You know, these moments of, you know, where, you know, nobody wanted to buy China and there was a big downturn, and whether it's inspired by stress in the financial system, or, you know, or very aggressive anti-inflation policies, or other reasons. So it's not unknown for, you know, China's had tough periods before, and I think, you know, but the eye on the long term and this, you know, the growth of consumption. I mean, just one statistic. I mean, if you look at the size of the consumer market today, between now and 2021, it's going to grow by, you know, 1.6 to 1.8 trillion dollars. That's the size of Germany, just in that period. Yeah. So, you know, it's a market that is driving, you know, everything, and driving all these, you know, e-commerce companies, tech companies, etc.
If I could paraphrase back to you, you could choose to focus on the government cracking down on a 10-cent game on the one hand, and that has had an impact on its stock price, or you could focus on the thesis that you just laid out for the long term.
Yeah, and and regulation in every country ebbs and flows, and so it's not it depends. The government will micro-adjust policies over time.
Afsana, please.
Volatility has doubled in the market, so that's
in
a
the
fact
global
of life
market.
In the global market, and volatility has also doubled, which is something interesting to look at. But more importantly, I think when we look at, let's say, China specifically in the index in MSCI again, there's so many Chinese companies that are not in the index, because they're these private companies. So the majority of Chinese companies are not in the index, which means the market cap of these companies is much bigger. So most likely the index part of any, whether it's the FTSE or the MSCI, the share of China will be increasing. Again, looking forward, not in the next few months, not in the next year.
Yeah.
And so most investors will be underweight China.
Yeah. Please. If we can get a mic to you right away. I hope. There you are.
Thank you. Andy Khalid, CEO of LNG Canada. We've been talking about the investment climate in other countries, but to all three of the speakers, when you now think about foreigners investing in Canada, just what's the first thing coming to your mind from three quite different perspectives?
I think you should start, Mark.
Yeah, so we have 15% of our money invested in Canada.
I'm sorry, did you say 15?
15.
Yeah,
15.
15,
Yeah, so, and it's an important, it's our home market. We should understand this market better than any other market. So, that's the first thing that comes to mind. It's a really important market. It's our home market. And we continue to invest in public market and private markets, in real assets, et cetera. And so, I think, the environment here is a supportive one for investment. And so, that's what I'd say.
Wei?
I think in addition to the investment opportunities that Morgan Stanley, obviously, we have, whether it's a real estate fund or infrastructure fund, we've been very focused on not only advising the clients and doing transactions for these clients, but also ourselves investing in funds that actually focused on improve the environment and lower the carbon rate.
Forgive me, I'm sorry. I just want to go to, we have a chance to get one more question in.
CEO of Genworth Financial. We're a large fixed income investor. And with a rise in the interest rates in the U.S. and the dollar versus emerging markets, we're concerned about a few countries. Wanted for any of the panelists, any views on over the next 2 or 3 years, issues in certain emerging markets.
Could you start, Afsana?
You're talking about uncertainty in the markets?
Yeah, which countries worry you the most?
So I think, obviously, depending on what happens with oil prices in the short run, oil importers will be more at risk. And then looking at the sorts of things we just talked about, countries that have a heavier a larger amount of debt, dollar denominated, with U.S. interest rates going up and the dollar getting stronger. So again, you would go back to emerging markets. Some of them that have the larger amount of dollar debt, the Philippines, Indonesia, et cetera, could be at risk. Turkey is trying to resolve its problem, kind of, it seems like these days.
Wei, I'll ask you to weigh in briefly on that.
Yes, and also I think just on top of that, the two countries in Asia Pacific, actually will do relatively better. Actually, not to exactly answer your question, the rest of them actually do have to experience a lot of challenges because of the rates increase that we just talked about. But India, Indonesia, in a different spot because the domestic growth very strong, and also they are relatively delinked with this trade tension we talked about.
Mark, do you want to call out any particular countries that would be concerning to you?
No, I think we're more of a view of this idiosyncratic rather than synchronized or contagion. So with that view, so it's very specific, and the two that have been on the lens that might be in Argentina and Turkey, where we have de minimis investment. So it's not